EA Sports, it's in the game, right? So EA Sports, Electronic Arts pretty much, actually announced earnings and it looks like they are up today 8% on earnings report, even though their earnings were relatively subpar. We can take a look at the stock news here on in our tool, and you will see that Electronic Arts actually missed on earnings and missed on some estimates, and they are still higher. You will see here what happened. They reported $0.8 per share profit, and the actual expected one was 1.43. So this is a significant loss. Yet still, the company's stock is up 12.2%. Now, net bookings are actually have actually missed estimates, but they still grew. They still grew 17.5% year over year. Net bookings, in case you are not aware, this is basically how many copies, how many digital copies or physical copies the company has sold, and it also includes things like paying to play and things of that sort, DLCs, whatever, or everything that the company pays, like cards and things of that sort, coins and all that. So, as you'll see here, for the full year, sales grew 24%, net bookings up 21.4%. But forecast, in terms of forecast, the company said that they are going to be doing 7.6 to 7.8 billion for 2023, net bookings of 7.9 to 8.1, consistent with analyst expectations, which is generally speaking a good thing. Business is not deteriorating, which is nice to see. And the interesting thing is that the downside is that they did warn that earnings this year will probably come up short again, which is interesting. And we're going to take a little bit of a closer look, of course, at the actual stock analysis chart here. Of course, as the stock price is changing, values like the PE ratio and price to free cash flow will be affected. These are basically changing daily, practically speaking. But you will see that today the stock is up 8%, so we're looking at a little bit of an more elevated price to earnings ratio right now. But we're sitting at 121 bucks, and if we take a look at the max chart, we will see that we're actually not that much lower from the highs of the company, and that's always a little bit concerning, especially in this current environment. The company has lost just 19%, which is probably a record high when you compare it to the other stocks that have lost like 60%, 70, 80%. So this one is still, keeping up pretty well, pretty solidly, and has a market cap of $34 billion. You will see that the PE ratio is really elevated here, and price to free cash flow though is much lower at 20, which is exactly what we would like it to be. Anything below 20 is actually very fair here, so I'd like to see that. And I'm much more keen on paying attention to price to free cash flow than price to earnings ratio. Outstanding shares is actually down 7.2% from the last 5 years before and ago, and it's actually sitting at 281 million. Free cash flow to total liabilities means that the company has quite some free cash flow to pay back all the total liabilities, pointing to a company that is very solvent. Of course, we will examine the details a little bit later. As 5-year revenue growth has been increasing, although net income has been going down a little bit. And 5-year free cash flow growth is also, generally speaking, increasing, along with the total equity growth of the company. Company is also paying a little bit of a dividend, 0.5% that is, with a very easy payout for the company. Free cash flow payout ratio 11%. The company is very solvent, can easily pay their dividends. The returns on equity are relatively okay, not great, not terrible. Net income margins are actually rather low for a software company, to tell you the truth. And if we take a look at the dividends report, you can kind of see the whole history. This is a very new module. You can see the whole history of the company's dividends, and you will see here that they are currently paying $0.17 every quarter. Okay, let's take a look at the financial statements. Of course, remember that if you can get access to this tool and pretty much have all these modules, all this information about any sort of stock that you want. You can become a Patreon, and once you do that, you get unlimited access. You can find links in the description box below if you are interested. So the revenue of the company has been increasing from 5 billion to 6.9 billion, and the net income from 1 billion here to actually 700 million, so it's actually going down. It did go up at 3 billion back in 2020, but then it's going down, so downwards trajectory, which is not great to see for the company here. The balance sheet has been pretty much increasing overall from 4.5 billion to to 7.6, although the last 3 years it has been rather steady, not much of an increase here. The cash flow statement, we are looking at positive net income, which is always a great thing, but that becomes a little bit higher because of the extra addition of stock-based compensation, depreciation, amortization here. And net cash provided by operating activities becomes about 1.9 billion this in the last year, 1.8 in 2020, pretty steady here. And cash from investing activities is negative because the company has been acquiring things here, it looks like. And also they have sold a few investments here. So they are a net seller of investments in 2022, as you'll see, fiscal year. And cash from financing has been negative. The company has been, looks like, repurchasing stock over here, which is nice to see. And also paying back some debt, paying some dividends too. They do have a little bit of cash, 2.7 billion, which is actually not as much as they had back in 2018, as you can see, for example. So their cash position has actually been lowered than what it was. And from 1.58 free cash flow to 1.7 billion in free cash flow. Not an insane increase here, it's still an increase, but marginal, practically speaking. This is a 5-year period from 2018 to 2022. Let's take a look at the stock evaluation tool though and to discover what kind of price to pay for the company. Revenue growth has been pretty nice for the company. It's only 2020 that actually went astray here. But typically speaking, they do pretty substantial revenue growth still. So we're going to go, let's just say 7, 9 and 11 here. And the net income margins, fairly typical for the company, 20, the odd one out over here. But I think we'll go something like 15, 20 and let's go 25 here. And the free cash flow margins, again, a little bit all over the place. Some of these are a little bit more elevated than I would think. Now, I don't want to use this kind of 200% values. These are very, very elevated. I don't want to go that far. But I will go something like 100, maybe 105 and 110 here. Annual return of 13% is what I typically want to make. And so let's just try this out and see what we're getting for our projections. Current price of 121, a high of 144, points to a company that could be an interesting purchase for our high estimates here, yet we're a little bit far from our medium ones. And I typically like to buy at least between low and medium, not really the high ones, to tell you the truth. So I would still want the company stock price to go below 100 in order for me to consider it a buy, and especially probably close to 80, to tell you the truth. This is what I would like to see. Although 11% in terms of revenue growth is definitely something that the company could achieve. They could also achieve net income margin of 25% and easily probably free cash flow margin of 100% even. So this is a projection that could actually come to play, to tell you the truth. And so if you are really interested in buying electronic arts, it may not be a terrible opportunity here. And currently sitting at 121 again, up 8% today. And it could have been a little bit of a better price if you bought a few days ago or so. But it's definitely a worthwhile company to take a look at and have it in your mind. Now again, I would like to get it at a little bit of a lower price if I were to buy this company, but you can get a little bit fooled by the PE ratio here. It's not as expensive as it looks like actually if you take a look at the actual stock evaluation tool and analyze through net income and free cash flow. So I hope you enjoyed the video. Interesting company here, some company to take a look at and add to a watch list for sure. And thank you for watching this video. I hope you enjoyed. Remember to take a look at this video that I made earlier. In this one I'm discussing Apple, a company that I really want to get my hands on, but only at the proper price. What is this price? Is what we're talking about in the video. Thanks for watching. I'll see you soon. Bye bye.